Hello and welcome back to the Fixed Income Securities series of NISM. Let's continue with the next chapter, that is chapter number 3, risk risks associated with investing in fixed income securities. The learning objectives are: after studying this chapter, you should know about risk associated with fixed income securities and risk mitigation tools. So, risk is inherent in any financial investment or financial instrument, and bonds are no different. While fixed income instruments provide regular income to investors, the investors can lose both the principal investment and the promised income if the borrower moves towards bankruptcy. However, such cases are extreme conditions, and the investors can gauge the risk level in a bond investment by looking at its credit rating. Investment in government bonds are considered as risk-free investments. There are certain inherent risks in fixed income products that can impact the net returns earned by the bondholder or investor. Interest rate risk is the single most critical risk for a fixed income security. Factors like inflation, liquidity, market intervention by the central bank, foreign exchange flows, price of competing assets, etc., influence the movement and level of general interest rates in the market. This in turn affects the market price of bonds, leading to the investment risk of these instruments. Chapter number 3, that is the risk associated with fixed income securities. So investors need to understand the risk involved in a fixed income asset before investing in it. Government bonds are considered as risk-free and hence provide low return on investment, while corporate bonds in general, being riskier, provide higher returns to the investor, assuming both were held from issue date till the maturity date. Entities like public sector undertakings or banks are relatively with the less risky vis-a-vis the pure corporate firms, and thus provide returns higher than the government bonds but lower than the corporate papers. Understanding the relative risk involved in fixed income assets help investors to decide the type of risk they are willing to take while investing. Major risks come from changes in interest rate levels in the economy and changes in the credit worthiness of the borrower. The first group of risk is known as market risk, while the second group of risk is known as credit risk or default risk. However, investors can hedge various risks in the fixed income assets by entering into various derivative contracts. The next chapter is chapter 3.1.1, credit interest rate risk. So bonds are subjected to risk emanating from interest rate movements. The price of the bond is inversely related to the interest rate movement. If interest rate rises, the price of the bond will fall. The same comes from the basic bond price equation, which is given here. So PV equals to C upon 1 plus R, the return percentage to the power of 1 plus C divided by 1 plus R, or rate of interest percentage to the power of 2, and so on. So here C is the annual coupon promised on the bond, R is the present interest rate for similar rated and similar maturity securities. FV is the face value of the bond that would be received by the investor at the time of redemption, and PV is the present value of the bond. The basic interest rate risk could be explained by the following figure that is given here. So this is chart 3.1, and here we have the price in y-axis. In x-axis we have the yield percentage, that is from 4 to 8%, and the price is between 85 to 115%. So as and when yield of the bond increases, the price of the bond would fall. In the above example, at 4.11% yield, our 5.79% coupon of GS 2030 semi-annual bond will, with face value of 100 rupees, maturing on 11th of May 2030, would fetch an X interest price of 113 rupees and 39 paisa on 6 August 2020 in the market. If this yield goes up to 7.86% with all other parameters remaining the same, the bond would be valued at 86.06 only. This inverse relationship is the outcome of the change in the present interest rate. Coupon on a fixed income security would have been decided based on the interest rate prevailing at the time of its issuance. Given the maturity and rating, if currently the interest rate has moved upward from 5.79%, as in the present case of the bond in example, for the similar kind of securities in the market, investors would not like to buy the old 5.79% security as it provides a lower coupon vis-a-vis new ones providing higher coupons. To enthuse the investor to buy the 5.79% security, the seller has to adjust the price downward to make it comparable with the new security that pays higher coupon. Hence, the price to be quoted by the seller would be lower than the 100 rupees face value. This situation would reverse if the interest rate moves below 5.79% and the buyers would have to pay higher price for buying the bond as the market would give them a lower interest rate for their alternative investment. This inverse relationship exists because of the fixed face value of 100 rupees is going to be received at the end of the maturity. The concept of pull to par explains the inverse relationship between the bond price and the yield. Any investment in bonds has two risks, market risk and credit risk. Market risk can be explained by the change in the price of the bond resulting from change in the market interest rates. Further, the coupons would be received at different points in time in future need to be reinvested at the rate of prevailing at the time of receipt of such coupons. If the interest rate falls below the present coupon of at the time of reinvestment, the investor would get a lesser cash flow from such reinvestment. This is commonly known as reinvestment risk arising out of market factors affecting the interest rate. So that's it for now. We will cover the next chapter in next video. And thank you.